Hi, everyone. It's Steven here with another episode of Steven in 60 Seconds or So. On today's show, I've got Sam Vakili, who's an investment and retirement planner with RBC Royal Bank. What I really like about Sam is he knows about the market, he understands it, and he's going to help us mortgage people understand a little bit better on how the market impacts mortgage rates and the housing market in general. Most of us are out there kind of buying houses, but Sam's going to link it so you can watch the markets, figure out what they need to do, and how it moves mortgage rates. Sam, over to you.
Thanks, Stephen. So, in an effort to keep this as clean and short as possible, the reality is, monetary policy, which is what interest rates are a tool for the central banks, is sometimes derived from how the market is performing. And the reality is, when the market does well, the economy does well, which means ultimately banks, or the central bank rather, can increase their lending rate or their prime rate, which is what we traditionally hear about when we're talking about mortgages. So it's not as though you watch the TSX or the S&P and say, well, if it's been a good day, we're going to see that happen. But when you look at macroeconomic factors across the board, like employment or rather unemployment, as well as how GDP is doing and how the markets are doing, that's what we look for as far as trends go. Now, the important thing that we want to watch out for is whenever the Bank of Canada meets, same kind of with the Federal Reserve on the United States, but whenever they meet every 2 months, they make a call to say whether or not they're going to leave their rates the way they are or they're going to increase them. And those factors are usually derived from how the economy is performing.
So is
So
the
that's
US market really linked to ours for the housing
kind.
market that way?
Sorry, ask the question again.
Is the US Federal Reserve, do they have a big impact on our housing market?
They do, in the weird sense that we try to generally stay within relation to them, because you have to think about it this way. If the Federal Reserve increases their rates, that means that their bond prices go up. When their bond prices go up, investors across the world will look for better places to put secure or safe money. So if they have a higher interest rate on secure bonds, then Canadian investors, whether it's external or internal, international or domestic, they're going to move their money to the United States. So usually they try and keep it. It's not obviously one for one, but that's why they tend to move in similar fashions, all else being equal.
Got it. Okay. So when our prime rate moves, what
Right.
starts to happen? What's the domino effect? What do we have to worry about every time our government gets together on a quarterly basis?
Yeah. So if they make the call to say that the economy is performing well and they increase their prime rate, ultimately they're saying to the rest of the economy, they think we can handle that crunch or that interest rate differential. And the challenge is both on the mortgage side, the line of credit side, but also on the GIC and bond side. When those things increase, it has an inverse effect on things like real estate and things like bonds. So that old term, which is why over the last decade, since we've been in such an aggressively low interest rate environment, housing has had such a continual boost. And the challenge Canada's faced with oftentimes is that it's very different in, let's say, the pockets of Toronto and Vancouver and Montreal versus the rest of the country. And you have to blanket the whole country with the same interest rate increases. So that's always the finesse that the Bank of Canada has to decide on.
A lot of times, the more something will happen in the mortgage market, rates will move, or housing starts are impacted, and actually, it's not because of the housing market; it's because of something else that's happened. Donald Trump has sent a tweet that he shouldn't have about bonds, or whatever the case may be.
Exactly. You
All right,
got it.
got it.
Exactly.
Okay. So now one number that a lot of people look at is the employment rates, right? Or unemployment rates for that matter. Is that going to
Unemployment rates.
impact their
Yeah.
tenants moving in and am I going to get good enough tenants, that sort of thing. Employment numbers, big part of this.
Yeah, at the end of the day, that interest rate movement that the Bank of Canada makes on the prime rate is based on so many factors, one of them being unemployment. So when unemployment drops, that's basically saying, okay, you know what, we're not having an issue of people being employed and being able to pay their debts. So that's generally a signal to say things are doing better in the economy. So that gives them more of an incentive to increase their rates, or rather increase the prime rate. So that's one of the many factors that the economists at the Bank of Canada will look at when they're making that call.
Love it. All right, that's perfect. Hey, listen, Sam, if anyone has more questions on this and maybe questions on their investments, that sort of thing, what's your phone number and email in case they want to get a hold of you?
519 575 2218, or you can just reach me by email, sam.vakili at rbc.com. Whatever works.
All right, that's perfect. Hey, thanks for your time. I really appreciate it. Everyone else out there,
My
if you have
pleasure.
any questions, don't hesitate to reach out. Sam, thanks for your time, bud.
Till next time.
You bet.